Welcome back. IndusInd Bank has recovered today, 2.5% higher. It's come off from the highs, but still, after the thrashing that it got yesterday, there is some green on the screen. The management exclusively told CNBC TV 18 that although there could be some decline in the net interest income in Q4, the bank will show a profit in the fourth quarter. Listen in.
What happened? Post that, you've seen that we've been very transparent with our disclosures. I think as soon as we got to know this disclosure, we've come and disclosed it to the market. This is a one-off item. It's not a recurring item. And I think we should take it, we should get over it in this quarter. And after that, I think the bank should be back to the BAU and you should see the growth that the bank is seeing and the profitability which the bank is used to. The full year will not be a loss at all. And I think the quarter 4 itself also will be a profit.
To take the discussion forward, Parag Thakur, Senior Fund Manager at Fort Capital, is now with us on the show. Parag, you would have analysed IndusInd Bank even before the events of the last 48 hours unfolded. The RBI extension coinciding with this update about discrepancies in their derivatives portfolio. Were you bullish on IndusInd Bank in the first place? And now what have you made of these recent updates?
So basically, first of all, thanks a lot for having me on the show. So IndusInd Bank, basically from valuation perspective, always looked very attractive. The only problem was when the microfinance issue started, we became very cautious and we sold it out. And luckily so, we were not holding any IndusInd Bank stock because of, and not because of this particular episode, but we sold it because we thought that 11% of the loan book was microfinance and microfinance was going through a lot of stress and we were not finding any answers to that. And so we sold. So we just got lucky, I should say. And after this now, in my view, of course, management has clarified a lot of things and promoters have also given statements that they are ready to increase stake and all. But I would say that the governance part of it, I think, because every bank, what I am being told is that after 2013, when taper tantrum had happened, RBI came up with many regulations in order to restrict this forex swap related losses, and which can be reported on M2M basis. I would say that I would still go with banks like Kotak, ICICI kind of banks, or HDFC Bank kind of names where, you are 100% confident that this kind of episode is not going to happen. And plus, there are other tailwinds also, definitely, as you were discussing just now, that, the entire growth narrative of US is taking a backseat. And so there is a selling in US market. We are hoping that some part of those can come back to India and which can come into large cap banks because what they sold was large cap banks. So from that perspective, we like Kotak the most because it is the most, I would say Kotak and ICICI, followed by HDFC Bank, of course. They are most well-governed banks and plus Kotak has many levers. Recently, their embargo got lifted on credit card. Their NIMs are 4.93. And I think they have very good levers to protect their NIMs in terms of their CET1 is 21%, CD ratio is 87%. Plus now they can grow their credit card book, which is high yielding, so they can protect their margins that way. Plus they have a very good secured retail book, which is construction equipment, tractors, which is doing well because of rural India recovering. Commercial vehicles, where they yield slightly higher than mortgage and AAA rated corporates, right? So they have margin levers also. They have clearly stated that their growth will be 1.5 to 2x nominal GDP growth. So there's a growth also. There is some margin protection also. And asset quality as usual remains pristine.
Right. Parag, take that point completely. You didn't have IndusInd Bank in your portfolio, but the stock is now almost 50% cheaper from where it was, maybe just around 6-8 months back. So at this price, does it warrant a fresh look at? And the other bigger worry as far as mid-cap private banks are concerned is there a possibility of a contagion effect? Could other banks see something similar play out? And in that case, would you like any of the other names? Some of them have seen significant corrections, names like AU Small Finance, an RBL Bank, a Bandhan Bank. Would you like any of those names?
No, I will. So it has been my stance since long that I have to be in a lenders where I am confident about governance first, and second, it should be a secured lending. Whether it is banking or NBFC, I prefer secured lenders because in unsecured lending, when economy goes through such kind of problem, when last year government was not spending because of election, when RBI was keeping liquidity very tight to control inflation. In this kind of environment, if you have an unsecured loan book, it becomes very risky. So my entire portfolio is tilted towards secured lenders, whether it is Kotak, ICICI, SBI, or whether it is Federal Bank in the mid-cap space. My portfolio, and I like to keep it that way only because I don't think so that, see, what I'm feeling is that government has started to spend. The effect of that has still not transmitted in the economy on the ground. RBI has done phenomenal work by infusing liquidity, by reducing repo rates, but that will show result in 2 to 3 quarters from now. So it is not a time to take extraordinary risk in the market. And lending is a very risky business because 80% of your total book is borrowed. So it's a highly leveraged business. So you have to stay with disciplined, well-governed, secure lenders. That is the message.
Understand that and take that point completely, Parag. Thank you so much for joining us. Hope to see you more frequently on the channel. Well, time now for a short break. We put the spotlight on JP Associates on the other side.